Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? It's Phil Tarrant here, co-host of the Pure Property Podcast with Paul Glossop. Every time I say that, I snigger. Paul Glossop, how you going?
Very well.
Founder, managing director, Pure Property.
That is correct.
Yeah.
Thank you.
What I don't understand is that you buy property all over Australia, but you don't seem to be on a plane very often.
Well, I have been. I could show you my passport internationally. I have
No.
plenty of stamps. Domestically.
Well,
we have a team, right? My job is A, to understand markets and be in those markets, but we also, when you're in a few markets, i.e. not just one market over and over, you have to essentially have that exposure. So I've got buyers agents who focus purely on WA, buyers agents who focus purely on Vic, on Queensland, on Sydney, and that varies. To be honest, we are flying as a company probably 3 or 4 times a week.
Okay, I didn't know that.
Yeah. Yes, there's a lot of travel.
Qantas or Virgin? Not Rex. Rex has went into liquidation.
It's never been Rex, unfortunately or fortunately.
That's because you don't buy in regional markets, probably.
That's probably got something to do with it. There is a hot tip. There you go. And then separate to that, no, it's been predominantly Virgin for whatever reason. I think the Virgin lounge option was always the preference for my team members, not the Qantas lounge.
Okay.
Yeah, preference. That's it.
There you go.
I think I would try to disperse the points that they get from their travels so they can use them individually, not for me as a company.
You don't need the points.
No, nor do I deserve them, Philip. So you can take a leaf out of my
So what's
book.
been going on? What's the latest?
Well, the latest is that it's probably becoming a bit more of an uneven market. I think that's probably the latest, is that we're probably past the point of this rising tide lifts all ships scenario. And we've probably been out of that for probably a couple of years now. But I think the latest is now there's probably a couple of early markets which we are buying in. There's probably some markets which are coming closer to the back end of their cycles, which we're becoming more selective in. But one thing that hasn't changed, and I'll try to find a segue in this somehow, is cash flow since these rate rises that commenced in 2022, in May 2022. Cash flows still remaining probably a challenge. And as part of that, we're finding that finance invariably becomes the challenge, and structures then get talked a lot about within finance when you're trying to find ways to get finance for the next purchase. And there's been a fair bit of hype around trusts versus personal names and a range of other things, which we hear all the time. I mean, I couldn't tell you how many times I get a phone call or initial meeting with a new client, a prospective client of ours, who talks about they've heard about a trust and they want to buy a property in a trust because it's going to allow them to essentially get infinite borrowing power and really allow them to go from 1 to 10 properties in a finite period of time. And my feedback historically has always been, well, you need to get feedback and advice from an accountant on that, because the reality is, yes, a broker can say one thing, a buyer's agent can say another thing, but the accountant is the authority on all things trust.
Well, allegedly.
There's a lot of legends in there. But legally, let's go with illegally. Let's go with legally.
Well, accountants are known as the trusted advisor, and I think property podcasts, call it that, or social media, whatever you want to do, it's a bit of a double-edged sword. So, it's allowed and facilitated the democratisation of information and therefore education, which is a good thing.
Yep.
The other side of that is that often the information that you get isn't necessarily the right information, and or it's not packaged up in a way in which you can synthesise it to determine whether or not it's relevant to you. Now, I think what you're talking about there is you probably have a lot more it's a larger cohort of property investors now who are dialed into creating wealth through property investment because they listen to podcasts like this. And there's a lot of people out there talking about pretty sophisticated stuff, which probably isn't necessary for the lion's share of property investors who buy between 1 and 2 properties in Australia. Well, I can't remember the number. Was it 89, someone on that number? 90% or thereabouts of Australian property investors own between 1 or 2 properties. Most of those people never even need to think about investing in a trust-based structure. However, people come to you saying, "Hi, Paul, I'm buying my first investment property. I want it to be in a trust."
Yeah, pretty much, mate. And my first answer
So is this misinformation, do you think? Or it's the information is accurate, but people aren't able to actually work out whether or not it's relevant Is the relevance of information?
I think the latter, to be honest with you. And I think that's where the challenge lies, is people hear it and all of a sudden you hear it by someone who potentially is in the realm of property investment space and is potentially a trusted advisor. And I think, well, therefore, that's exactly what I should be doing, and I won't take any other option as a way forward. And I think for me, that's where you really got to ask the question: is why? The answer is no, you shouldn't. It's certainly not no. But for me, the response always when I do get that question asked is, or when people say I've been told I should put in a trust. My question is why? And if they can't articulate that, typically you know that they've just heard it. Yeah. It's been very brief, and then they need to really unpack that a lot more because invariably, to your point, Phil, mum and dad investors, PAYG, who even if they're on decent incomes, buying their first investment, might have their own principal place of residence. It's typically very, very hard to see how, yes, look, put this in a trust, that's going to be the best way forward for that first investment. It's usually quite hard to see how that actually makes any sense. Yeah. But again, I guess that's why I always say defer to an expert to really give you the crux of the pros and cons, because it's certainly not a one-way bias conversation either.
No, it certainly isn't. And I want to use this opportunity to dispel some of the myths then around investing in or through trusts outside of our skill set and pay grade. So you've brought your accountant kicking and screaming, the man who normally hides in the shadows, soon to come out of the shadows.
He's been behind these black drapes the whole time.
Just
we talk about him too much.
And listening in. Munzurul Khan from KHI Partners. Munzurul, how you going?
Very good. Thank you.
It's good to see you in the podcast.
Good to see you. Thank you.
You're a wealth of information, untapped information when it comes to property investment. Completely unsubscribed. People need to know more.
Thank you.
Trust-based investing. Is it for only the few or the most?
Phil, there's so much noise at the moment in the open world, right? There's just absolutely so much of the noise. I was speaking to one of my partners the other day. I was saying that I'm spending more time of convincing people not to be on the trust as opposed to being on the trust. And this is coming in from someone who loves trust. I personally got about 9 family trusts. I've got a whole bunch of properties in the family trust. You know, we all have trust, but there is a time and place for it. I take a step back, right? You raise this point that there's a whole bunch of cash flow issue at the moment in the market, right? And I almost sort of consider that whether it's that old sort of the FOMO, fear of missing out. One is that with the cash flow, and the second is that the fear of missing out that we can't buy more, right? It's I'm hearing over and over again is that this unlimited borrowing ability on the trust, right? It's sort of uncapping everything. It's something new. It's never been considered, and it sort of came in everything as a new, right? I've been hearing this over and over, but it's not new. No rules have changed in the last 6 months or 12 months or 2 years as such. Nothing has been changed. It just seems that it's being marketed in a different way at the moment. There are some elements of truth with the marketing side of it, right? There are some elements of truth. So is it for all? Probably not. Is it for some? Definitely yes. And Phil, if I might go through what are the positive and negative, right? And why do people speak about the trust? So when you sort of say that when someone comes in, you ask the question, why is it on the trust? Trust has some merit, right? Number one is that trust gives you asset protection because you don't own it, you control it. As a concept called appointor, through the appointership you control. So that's a tick. Number two, trust also has a tax flexibility. You're buying this property for $1 million, you've done a bit of work for about 100,000, you're selling it for 1.8 mil at a particular point of time. That capital gain that you have, let's say 1.1, take away some cost, 600,000, that capital gain that you have, in a trust your benefit is that you can distribute that profit to the beneficiaries in a very wider way. So you get a whole bunch of tax flexibility. You get a 50% discount. Those two was always there. We always spoke about those two as the positive of the trust. We sort of balanced it out saying that there are some negative. Negative is that trust has got a setup cost, right? And it can become a little bit pricey. Trust has got a running cost. You annually need to do a set of accounts, tax return, pay all the ASIC fee. So there is a running cost to it, right? If the trust has got negative gearing, you can't utilize the loss against your individual name. So that's a negative. Many of the states, the trust, the land tax is a lot higher. New South Wales, as an example, that there is no threshold. You pay land tax from $1 as opposed to individual, you've got over $1 million threshold. Queensland, as an example, $350 as opposed to 650 odd grand. So you pay a lot quicker, right? So we always is to balance it out, saying that, well, buying it on trust benefit is asset protection, tax planning, longer term, Negative is that the setup cost, running cost, negative gearing, not to be able to utilize, as well as the land tax, right? So it's a positive and negative. I think what has changed in the last, say, couple of years or so, I've been hearing so much of this unlimited borrowing ability on the trust. And if we go deeper to it, where that concept comes in is that most of the bank, there are some exceptions to it, right? But most of the banks, what it does is that if a trust is positive as a cash flow, then you can go to your accountant and you can get an accountant's letter as a confirmation saying my trust is positive cash flow, my income is higher than my expenses, so it's sitting as a positive, it's distributed the profit. Then what the bank does is that the bank sort of takes away that trust, saying that it's a self-sustaining trust. And because it's a self-sustaining trust, bank doesn't take that entire level of borrowing that you have within that trust. So the bank does the simple assessment outside. So if I give you an example, right? Let's say a mom and dad investor, they've got about $3 million borrowing on their personal name. They've got a bit of asset on the other side. In the trust, they've got $1 million borrowing, and they've got an asset against it, $1.8 million as being the asset. If that trust is positive cash flow and the accountant provides a letter saying it's a positive cash flow, bank doesn't take that borrowing into account. Bank only takes this borrowing into account. That means, in theory, your serviceability has increased. Because the way the serviceability that very often the bank does, right, you add away a risk factor, whether it's, say, 2.5%, 3%. There are some exceptions, like CBA, I think, does 1%, but generally speaking, right? And you also do a P&I, and you reduce the loan. So it's a very conservative math of the serviceability. So if you can extract that bit of the borrowing, all of a sudden it increases quite a bit. The challenge is that there are a number of challenges, right? Challenge number one is that whether the bank, yes, these are the rules, are the banks going to change the rule in future? If they do, what do we do? Question one. Question number two is that your property is a positive cash flow at the moment. Is it always going to stay as a positive cash flow? What happens in a year that you are doing refinances? In this particular year, that property wasn't rented for about a couple of months for a whole bunch of reasons, right? Or you had a whole bunch of repairs and maintenance cost. It just happened to be negative on that particular year. Your accountant can't give an accountant's letter saying it's positive on that year. That to me is also a risk. Like that accountant's letter is not a permanent. It's more of a transient in my mind. So that's a genuine risk, right? And the third level of the risk, which also comes in, is that what happens if you need to refinance that trust property? How are you going to refinance it by ignoring that trust liability? So that's a risk, right? So there are a number of those elements that comes in, and I think the view comes in is that unless and until one really understands the nitty-gritty of that sort of the trust structure, how it increases the borrowing, one must not be jumping into it, my view.
Okay, well, that's a pretty considered and detailed view.
Unscripted.
So to dispel this myth that there is unlimited borrowing through a trust, I think what Munzurul has just told us is that, no, it's not.
Yeah.
It's not.
And this is the part which... There's a few ways. I mean, and I probably we look at this as a lens of someone who's buying their first investment. We can look at this as at the lens of someone buying their 10th or 100th investment. It's not really dissimilar. So working off the math, and I think if anyone's going down the pathway thinking, I want to buy in a trust because, and if their main reason, because your point, Munzurul, you've sort of highlighted those things that haven't changed around the asset protection, around tax and profit distribution potentially, but then the downside risks around potential land tax thresholds, higher borrowing costs, and a range of other things that come with it. Those things have been on the level for a very long period of time. We're not talking about those because they haven't changed. When we talk about this new phenomena about unlimited borrowing potential, what does it mean if you're borrowing? And I worked off the math just then very briefly as you were going through because I mentally need to sort of compartmentalize. So what does this mean from the mathematical standpoint? So if you were going to buy a $500,000 property and you're going to put it in a trust, you're probably going to pay 0.5 to 0.1% higher premium for you borrowing your money. So I did the math on about, say, 7.5% interest-only rate. Now, if you're borrowing the maximum, of, let's say you're borrowing 100% including costs, and I'll just put that in there, just assuming that you're leveraging off your principal place of residence and you're taking some equity from there, you're going to buy your first investment. Let's just assume you're borrowing 100%, not even 105, just 100% of that. $500,000 purchase, $500,000 loan. If I look at the rent that you would have to achieve if I work off that basic math to say how does that property become cash flow positive to then get the accountant's letter to then go back to your broker to say, look at this, I'm a good boy or girl and I've got a $1 positive and I'm going to go back to the bank and say, disregard that, let's do it again. So for a $500,000 property, to get the numbers to be cash flow positive, that property has to be renting circa $875 to $900 a week on my math when I worked it backwards. So put that in perspective, you have to buy a $500,000 property, and this factors obviously in things like council rates, water rates, property management fees, your mortgage repayments, your insurance, etc. So that's the number to then go back to your accountant for them to legally say, yes, I can see quite clearly based on your financials that property is cash flow positive or solvent as a business. And that's the math that you have to figure out, is that how many of those properties actually exist, and if they do exist, is that property actually going to appreciate in value? Because ultimately, if a property is giving you $1 a year positive or $5,000 a year positive, is that really going to move the needle, and is that the purpose of buying this property in the first place?
Love it. Love that as statistics, Phil. And the reason I sort of love that is that while you're doing this, right, your 850, 900 is that you literally goes more towards about, say, 8.5%, 9% gross return, if not higher. Now, question number one is, as you raised, is that do we find those sort of properties in the open world at the moment? Number two, if we find it, what's the location that we're looking through? And number three, what are the risks against it, i.e. that opportunity cost in terms of giving away that capital growth over a period of time? The alternate option, what I've seen at times, is that sometimes the funders sort of come in and say, well, yes, okay, ideally we should be borrowing, let's say, or whether we should be borrowing that 100% by using cross-collateralization equity. But can we borrow less? Can we borrow, let's say, 60%? Can we borrow 50% as such? Yes, you can make it a little bit more positive cash flow by borrowing those. But it becomes a fallacy because you're giving away all of those equity. You're giving away all of those potential that you can utilize it, right? So you're right. I mean, it does become fallacy, yeah.
Yeah, so I guess what you articulated there is that you could probably bring down the LVR and make it a lot more cash flow positive, and you don't have to get that 875 to 900 a week. It might be more like 600 to 700 a week to get that same property cash flow positive. But then all of a sudden, like you said, you've given away all of your seed money to actually be able to build your portfolio. And if we go back to 10 years, 15 years, 20 years ago, when we were all probably building our property portfolios, the game wasn't, all right, great, I'm going to put everything in a trust because I can buy infinitely. It was still a game of attrition where you try to buy well, see the growth come, manage your cash flow, wait until the market gives you the ability and your funder gives you the ability to borrow. When you get that tick, go again.
So you guys are a lot smarter than I am. I see a lot simpler, and that is people start looking at trust-based investing, I would say, as a primary purpose because they can't borrow any more money in their personal name. Yes or no? That's the base fundamental. What we're talking specifically around here are people who are aggressively trying to build a property portfolio and they've been told because of interest rates and whatnot, you can't borrow anything more. So they go, I've got a solution, a trust. Yes?
Yes, in the sense that if you've got enough level of equity, enough level of cash flow, you sort of come into the market. Let's say if you buy a commercial property for argument's sake, right, and you do a lease stock as an example, then the trust is self-sustaining. That's fine.
Yeah, it's different.
If you buy a residential property as an example, if you bring in enough level of equity as a cash, right, you've drawn down against your other property as such, you brought in cash, you brought in into, say, 50 or 60% LVR, then you can challenge. What I have feel is that I'm getting more and more mum and dad investors who's sort of coming in saying, well, we'll do it the other way around. We'll buy the very first property on the trust. First investment property, I want to buy it on the trust. Or maybe the second investment property that I want to buy it on the trust. That's where the challenge comes in. Their logic is that, well, if we buy it on the trust, is that I'm giving longer time frame for the rent to grow on this property as such. And because the rent will grow, longer time frame, we're buying it earlier, we're giving more opportunity for it becoming more positive cash flow. There is a logic to it. I hear it. But there is just so many risks attached to it purely because that every year, the accountant's letter, every time when you do a loan, all the extraordinary circumstances that if funding sort of changes, banks sort of changes, so many risks.
So back to the point. I can't buy any more property in my personal name or my partner's name altogether, so therefore we look for trust-based investing because we're committed to it, to building up a property portfolio. That's great, right? So in order to start investing in a trust, you need some seed dough. Where's that money traditionally come from? Someone refinances their personal debt, so probably even that's what taps them out, right? So essentially they're completely tapped out on their personal funding. So the only way they can advance moving forward is through trust-based investing because everything's going to be tied up in that. Now, in order for that trust to be positively geared, I challenge anyone, you do it for a living. How many properties can you find in good locations that are going to be positively geared if you're borrowing 80% in Australia right now?
Not many.
Not many.
Yeah.
Not many at all. And
So-
that's commercial or residential, by the way.
I'm just talking resi, right?
Yeah, but resi or commercial.
So the idea of accelerating your property investment journey, investing in trust because you can buy more property, in order for it to be positively geared, it's just a beautiful
myth.
catch-22, right?
Absolutely, it's a
you know,
myth.
in order for that to be positively geared, you're going to have to put more than 80% in, which means that you can't buy two properties. Is that which case? There's only ever going to be one.
You don't have the money
Yeah.
as the deposits
Yeah.
or the collateral to do anything after
And if
that
you
one.
choose that place in the wrong place, you don't get capital growth, you're stuck, and you're not going to get the cash flow, so you're stuck.
And then you have the catch-22 of then not being able to refinance that property, even if you do get the funding for that one in the first place. Because to Munzurul's point, who's to say that you're going to see that property improve in value, and then all of a sudden if it's stuck and it's in a trust, and then all of a sudden you're paying a high premium, you're paying the land tax, all those negative things, do you invariably end up holding a dud for longer because it just hasn't really worked out like
Because you can't
thought?
move it.
And,
Well, it's complicated. It's very, very complicated. So, Munzurul, I'm not a smart bloke. Most people shouldn't be investing in a trust.
Look, I
Is
think
that a fair statement?
I think there's a time and place for it, right? And I
Yeah.
want to go through the time and place, but if I might just touch this one particular point, right? That example that you've given that I'm sort of stuck in my property side of it, I want to set up a trust and I want to buy it on the trust and whether that's the way forward, right? Now, where is that seed money coming from?
Yeah.
That seed money is coming from either some level of equity drawdown or maybe some other liquid asset which was sitting into your some level of offset account which was saving you some level of funding, right?
Yeah.
So when you take that seed money out from your equity drawdown, is that if we try to claim that as a tax deduction, technically we can claim that as a tax deduction, right? So I borrowed a 200,000 against my principal place of residence, and by using that 200,000, I use that as a deposit. I've got a bit of cash. I'm buying this property on the trust, right? Technically, I can claim that 200,000 as an interest deduction. But as soon as you start claiming that as an interest deduction on the trust, you are claiming 100% of the borrowed money, means that it goes back to negative.
Yep.
Right. So you are onto that when we speak about that catch-22, right? You're in that position is that if you want to give away all of those deductions for years and years and years and years for one to sort of consider a trust, again, it sort of becomes quite sort of difficult. Yeah.
So a question for you, Munzurul, and this is probably an ethical question.
Yeah.
What is the code of conduct for accountants? So,
Good question.
So if you've got a property investor investing in trust and you're an accountant, I'm not talking about you or your firm, and they're going, just write me a letter, don't worry about it. Like the accountant is obliged.
100% feel.
They can't. That's a professional duties and ethics around it. Has it got a name, or is it just like doing the right thing?
No, Phil. It is absolutely 100% in terms of that one cannot be taught of negligence. One cannot be, in any shape or form, is not to do enough work before they do the accountant's letter. For us to do the accountant's letter, it needs to be auditable accountant's letter. Means that from us, as an example, we've got the institute, we've got the ATA. Anyone can come in and ask us that, how did you prove that accountant's letter that it is positive cash flow? There's so many catch point to it, right? I've seen some of the accountant's letter now that they almost do a forward projection of the cash flow, saying, all right, the rent is about $600, the lease expiring in a couple of months later, the rent would increase by 10%. I was being told by an agent, and I do the new maths. Then I do 715 as opposed to 650 as the rent, and by doing it this way, it will become a positive cash flow. Here is the accountant's letter. That's not it. Accountant's letter is a historical letter on the basis of what it already happened at that particular point of time, or maybe right at this stage. So we need to have the substantiation behind it. And some of the accountant's letter that I see is that it gets manufactured. So a strategy that I hear quite often is to say, well, we borrowed that, say, $600,000 against a $900,000 property. You know what? I'm going to bring in $200,000 as my cash, leave that in the offset account for a period of time. So it does become a positive cash flow. You give me an accountant's letter, and then I say, okay, but what are you going to do with those bit of the cash? Is it going to stay in the offset account forever? No. Once I get the accountant's letter, I'll take away this. I was like, guys, we can't do it that way. It's not the economic reality. It's not the truth. So one got to be careful.
And that's you've probably pointed on one of the ones that if I've heard of clients of ours or prospective clients of ours that have come along and said, here's how I know it'll work, is pretty much exactly that. So I did this equity redraw hypothetical of $1 million property, and I drew down $250,000, And for a very finite period of time, I moved that cash into this mortgage account on this investment, did my math, essentially showed that it's solvent and it's cash flow positive. The day I got that letter, I shuffled that cash back out and then moved it back over. So technically, yes, for that very, very finite period of time, it was cash flow positive. But that's not a permanency. That's not the reality of how this property is going to function long term. And then if you added in another property, but to your point, Phil, if you ask yourself the question, is this going to be logically solvent after you add the next property and the next property? No, of course it's not.
And people are lying to themselves, right?
Exactly.
Let's look at this, because if the bank says you can't borrow anymore, you're tapped out based on what you're doing, how much money you make, stuff. So therefore they chase trust. You probably shouldn't be operating your financial affairs at a knife edge like that.
I agree. Absolutely.
It's a basic fundamental thing, right? Like, you've got to be responsible and accountable for your own finances. And if people are going to redline it that far and try and manipulate and maneuver to get it to a point where you might be able to borrow more inside a trust, like what happens if stuff doesn't work out properly? And it happens more often than it doesn't. People make the wrong investment decisions.
And Phil, history is amazing, because when, say, you and Paul and I, we've sort of been investing over many years, we've seen so many things in the past, right? And we sort of relate back to so many things. Being investing 25 years, right? And there's at least 2 to 3 times in the past, in the history, is that I had to battle quite a bit saying that trust is a good thing, invest in trust. After about few properties as such, there was this enormous myth that you cannot get any loan within the trust doesn't have any loan. And I still remember, right? Now it's sort of completely the other way around, saying that it's all about the trust, it's all about the trust, it's all about the trust. Sometimes what it does, Phil, is that when we are right in a moment, we almost lose into that bigger picture. Funding is difficult at the moment. We get that. We hear that, right? The interest rate is high. It's very high, whether it's going to increase again. And, borrowing is very difficult. And it's sort of almost people are over trying to buy as much as they can within that short period of time. All we have to do is that just have to have a bigger perspective, longer term perspective, saying that we're going to stay within the bank guideline. Banks are there to lend us. And if the bank is sort of saying that we cannot lend you, we got to be listening to it for our own benefit, right? And we just to stay with the time, let the rent increases, the prices will change a bit, right? And the interest rate will get managed and things will change again. Yeah,
with trust-based investing, you've got to be careful what you wish for, because it is a lot more expensive investing inside of a trust, particularly from a land tax point of view, right? Like, I'd hate to know what your land tax bill is, or your mine. I know my land tax bill. Like, I pay a lot of tax, and land tax just adds to it even more. But
you cannot avoid it.
You cannot avoid it, but that's a cost to operate, right? It's a business cost to operate, and we need to remember that we're talking about a business. You're operating a business. If you're a property investor, you provide rental accommodation to people. That's you're an asset manager is what you are. So there's a whole bunch of costs come along with it. Do you think a lot of people who they come and chat with you, Munzurul, are actually informed enough about what constitutes investing inside the trust? They just think through rose-coloured glasses. The outcome is that, hey, I can control more property, but the realities of tax returns and all of that sort of stuff, like, which is every single year you got to do it. It's quite tedious and onerous at times.
But I'm getting so many of those mum and dad investors, it's sort of their first investment property. Their second investment property, they want to start with a trust.
Why is that? Are they just tuning into podcasts and they're hearing it and they're going, that's what I need to do, or that's their recommendation from a buyer's agent?
Look, I don't know whether it's necessarily a recommendation from any particular profession as such, right? Particularly with the buyer's agency side of it. But I think there's just, it's when we speak about that fear of missing out, we want to buy it, we want to keep progress, we want to keep moving. We keep knocking at the bank's door and the bank is saying, you can't borrow, you can't borrow, you can't borrow. Then all of a sudden someone comes in with this brilliant creative idea saying, you can borrow, you just need to do a trust. So it's sort of whether it's almost the human nature is to sort of say, well, you're the savior and I've got this light and I want to do these things, right? Without having that sort of the bigger picture in our mind. Because see, once you buy in the trust, right, you are into the trust forever. You got to do the set of accounts every year until that gets sort of finalized. Now, saying all of those, Phil, I go back, I don't think I've answered that question. You sort of say, so do we buy it on the trust? Do we not buy it on the trust? Is it for everyone? I'm a big fan of trust. After saying all of those things, I'm genuinely is a big fan. I've got multiple properties on the trust, but I've sort of, for the last 20 odd years, I said the similar sort of things. Buy the first few properties on individual name. buy your principal place of residence, buy a couple more properties on individual name. By doing it this way, utilizing the land tax threshold, and you're also utilizing a good portion of your tax benefit as such. And once you absorb those, that's where you start to progressively go into the trust, right? And that's where you do. So we've got investors who's got multiple properties, 6, 8, 10, 12 properties or even more. Trust there's a lot of merit to them. A lot of merit. And, many of those investors, we genuinely provide an accountant's letter. Yes, we do our due diligence and we cross it over and we sort of say if we get audited, we've got all of the substantiation. They are the one that this product has actually been created. I think it's not so much the product that we're questioning. What we're questioning is the utilization of the product. And to mom and dad investors who are right at the beginning, perhaps they are not being as informed in terms of utilizing that product or as sophisticated as yet.
Okay. So do you think anything's going to change, Paul, in relation to attitudes or aptitudes towards this trust-based investing? If you're encourager for the right sort of client, and by the way, we're not offering advice to anyone in this particular podcast. If you want advice, go and speak to an advisor, i.e. Munzurul. He can actually give advice. We can't, but is it more of it's probably not right for you. Maybe you should just wait a little bit and take it easy.
I mean, I always try to give my personal circumstances as that example. I know Munzurul just mentioned, the quintessential client who probably should be buying personal names before they're exhausted their own ability to reduce and minimise their tax in a PAYG scenario potentially. And once they get to that point and they still want to continue going, then there's opportunity to say, okay, well, now it probably makes sense to go elsewhere. If a client, we're talking about is 1, 2, maybe even 3 properties, and my personal preference is it's always deferred to an accountant and making sure that they get that expert opinion. But trying to run those numbers that I did sort of earlier when we were just talking to say, look, here's the reality of the way I see it. If you did buy in a trust or if you didn't buy in a trust, the numbers and then the property type that supports that type of purchase with that philosophy of infinite buying opportunity, is it actually going to be viable? In those situations, which is those first, second, maybe even third investment, it's hard to see how it actually stacks up anyway. There is certainly times where it does happen, and I think will it be something that we see will continue to prevail? I kind of liken it to the lease stock phenomena that sort of spawned its way out of COVID, where I could be completely honest with you, I didn't have a single client approach me prior to 2020 talking about buying a commercial property under a lease stock scenario. This was something that came completely out of a low interest rate environment and an opportunity where people thought, hang on, here's a product that supports me not putting any money down by an investment that essentially only has to wash its face via the actual money that comes from the existing lease on a property. And then all of a sudden people thought, this is a product that gives me infinite ability to just keep controlling a huge amount of assets. Go talk to someone about buying a property under a lease stock scenario now in 2024, and I can guarantee you the landscape is poles apart to where it was in 2020, 2021, even 2022, where you could actually find documents that supported or banks who supported that just don't stack up because of the interest rate environment that we're in. Now, if interest rates do move downwards in the next couple of years, there's obviously every chance that they will, and definitely not to the levels of what we saw 2 or 3, 4 years ago, but potentially down a little bit that makes cash flow a little bit more available. Probably opens up that gate a little bit, I think, for a couple more people who probably maybe make sense for trusts. But holistically, on averages, it typically is certainly probably more like a 1 in 10, 2 in 10 scenario where I would say on average it makes sense versus doesn't make sense if I'm just genuinely working through the average of who makes sense and who doesn't make sense for it.
Paul, it's about looking that long term, right? Because the investment is not only just to go over that immediate term and rather than buying 2 and bought 3. It's not the numbers, right? So that's one point. The other point is that, Phil, is that we're being petrified a couple of times is to receive the advice saying that, okay, this client of mine has got this 5 or 6 properties. Someone else looked into it, a financier, mortgage broker looked into it saying that, all right, you can't do this. But what he can do is that he can sell property number 4 and property number 3. And by selling property number 3 and property number 4, you've got all of those cash in your hand and you bring that back into a trust. And by doing it this way, rather than having 2, we can now buy 3 or we can buy 4. And the client is also excited is that I've found a way of sort of having 2 properties. Yeah, give out 2, but I'm getting 3 or 4 properties on the other side. Those sort of things is that we got to just, even though I hear it, there could be a genuine reason why you want to sell number 3 or number 4, right? You don't have a lot of growth potential. It's costing you a lot of things. There's less demand on those areas. Many reasons that you can do it. But I don't know whether we can just sell it purely because of finance, of getting more finance, because there is a selling cost, there is a repurchase cost, there is a capital gain tax, and also one suggests that there is an opportunity cost. So we just got to be reasonably careful, yeah?
So it sounds like you guys are the merchants of doom and gloom around trust-based investing.
I think it's probably worth tempering this with saying, well, okay, well, let's walk through a scenario where it does make sense, because we've kind of danced around that. We have talked plenty about where it doesn't make sense.
And by the way, we all invest in trusts.
Exactly.
Yes,
Well, that's what I was just about. Let's lay that on the table.
trusts.
All of us here have many properties within
trusts.
trusts. And also, personally, I have property in personal name,
Yes.
which was certainly bought for a reason at a point in time. But maybe I think Munzurul is probably the person who's best to answer it from a tax standpoint. When does a trust actually make sense? What are the scenarios? If you're thinking, okay, well, who would be a candidate? And people who are listening might think, okay, well, I potentially am that candidate.
Look, if one were to buy commercial property, there's a lot of logic to it, right? Because very often what the commercial property, what they do is that the tenant effectively pays all of your cost, including the land tax, and so if you can negotiate. So that's a tick, right?
So there's less operating costs investing in commercial.
Almost sort of no operating cost depending on how
so
you
you essentially you've got to pay for the
interest.
the debt. Otherwise, it's I like commercial.
Maybe land
basis,
tax, maybe.
A land tax is normally paid by the
Depending.
Yeah.
Subject to
Maybe
negotiation.
subject,
Some of
yeah.
the land tax is sort of either way, right? But very often you can negotiate that the tenant pays it. So that to me makes sense, right? There is a logic to it. It can be self-sustaining. Bank provides the loan. There's a whole bunch of logic to it. Residential properties side of it, I go back and I sort of say first, few properties on individual name. Then one can definitely look into trust. There could be some exceptional circumstances where you may wish to buy it on the trust early. As an example, I bought this block of units or block of land that I'm going to develop, say, 3 or 4 townhouses, villas, and you know what? The end result is that I'm definitely going to sell it. I'm not going to hold on to it, most of it. I'm going to sell it, right? So on that example is that where we bought it for $1 million, we're doing all this construction, we're selling at that particular price, we're making a significant level of
So you're
profit.
compartmentalising your tax affairs
That's right.
inside
and
of
you
that
can
asset.
Spread that as such with the tax side of it. There is a logic to it, right? But just mum and dad in terms of buying their first or second or third investment properties, which is very long-term buy and hold, I struggle with the trust, right? At that stage.
See, I thought accountants would be going, set up a trust because they make fees out of it. That's what the cynic
Which
in me
they
would
do.
say. It's
Yes.
expensive, right? Like it
It's
costs you because.
expensive.
So talk us through so you got to pay to set up a
Yes.
trust,
Yes.
and a trust is a trust, and then also the trustee, right?
That's right.
Which is a PTO Ltd.
That's right.
And that controls
That's right.
the trust. So
That's right.
that's two companies,
Yes.
well, two entities essentially,
Yes.
which costs to set up, and then you need to do tax returns every single year for the trustee company.
That's right. You got to do the tax return for the trust, right? But you also need to do the financial accounts for the trust. So it's not just an additional tax return. An accountant, we need to do the balance sheet and the P&L and the notes and everything else because we need to disclose them.
Yeah.
So your running costs start to become a bit expensive, right? Then you add away things such as your ASIC fee and annual fee, a couple of $100, but it sort of adds away all of those. But the land tax is the one, right? The land tax is
Land tax hurts.
it's the severe cost. Like in New South Wales, as an example, is that there is no threshold on the land tax on the trust, right? So it becomes expensive. Even the setup of it is that you've got a family trust, you've got a trustee company. The setup is expensive. The running cost is expensive as such. Coming back to that point, I've got trust, right? I'm actually is a really big fan of trust. But this whole comment in here is that there is a time and place for it, number one. And number two, not to be over eager, I suppose, of trying to really artificially bring it in and not to be over eager of saying, wow, I've got this brilliant idea came in, no one has ever thought about it. People are investing over a generation.
Yeah, and that's another sort of estate planning is another
Yes.
great aspect of trust, which we haven't spoken about in terms of long-term continuity of your assets, right? It makes your property is a lot more portable for the purpose of estate planning and transitioning, correct?
Yeah, good question.
Yeah.
Good question. I mean, the estate planning, good question. The estate planning is a whole bunch of areas, right? Trust also has got a limited life, right? It's not indefinite. Trust has got this concept called vested life. And generally speaking, it's either 70 years or 80 years. Means that after 70 or 80 years, it dies. Now, we don't speak a lot because we say 70 years.
Someone else's problem.
It's really not this generation, it's
Yeah.
the next generation
Yeah.
issue, right? But when it comes to the estate planning is that there is a whole bunch of things that one needs to do in terms of the trust side of it, right? You've got this concept called appointor. So the appointor needs to be right. Then you've got the trustee company and the shareholders of the trustee company, they need to be right. And if they're not right, then you don't have that control as such. On an individual basis, is it a bit more portable? Individual goes from him to her and to the next generation as such.
And you asked the question a little bit earlier, Phil, is what's the what's the appropriateness of a trust, and is this something we expect to last or be around for a while? I think we've probably seen, in conjunction with this cash flow constraint that's happening right now in the market and people getting priced out of wanting to continue to build their portfolio, SMSF purchases have been a really good substitute for people who are in the right spot with the right objectives and probably buying the correct assets. That's the part which we've seen explode realistically over the last probably 2 or 3 years in particular. And Munzurul, you'd be on the coalface, I think, seeing how many people are actually applying. You'd probably be able to do an audit within your business, like what's the volume of SMSF versus non-SMSF. But in its essence, that's been a way where I've seen people potentially say, well, I'm priced out of being able to borrow in my personal name. I looked into trust, but that's probably not going to be the correct purchase for me. But these are the same people who say, well, I might be in my 30s, 40s, 50s. We've got combined super of $300,000, $400,000, $800,000. We've got 15 years to retirement. We can't buy any more in our personal name. We've leveraged out there. We've got a pretty manageable debt. We want to keep building our portfolio because we probably want 1, maybe 2 more assets, but we just can't do it. A trust, we could do it, but doesn't make sense. Maybe, maybe not. SMSF has sort of now come to the forefront of saying that's the avenue rather that some people are taking.
No, absolutely. And Paul, you are absolutely right that there's just so much of that SMSF sort of queries that we're sort of saying. The comment which we must say in here is that naturally everything which we're speaking is that generic, right?
Correct.
Even with all of those finances comments that are made is that I'm an accountant, I'm not a mortgage broker, but it's just over the
Look at him with his disclosures.
I have to have those disclosures, like I have to. Now, same with the self-managed super fund. An accountant cannot give an advice of whether to do or not to do a self-managed super fund. This is where you need a financial planner who provides a SOA, statement of advice, right? But what an accountant can do is to provide you a whole bunch of positive and negative of the family trust, the superannuation. Now, what I've seen from my experience, what I read from the experience is that there is a bit of a cut-off point, right? That anything below 250 odd grand, one probably should not be doing a superannuation fund. Anything above that, one may consider a superannuation fund. The benefit is that number one is that you've got that leverage. You can borrow up to 80%, provided that the cash flow is there.
Even 90%. I think Granite are a product even now. But then there's some costs there.
A little bit pricey, but you can go 90%, right? And up to 80%, right? 80 to 90%, right? So that's one. And the second is that it's sort of, if I consider that, it's a genuine cash down deal. Anything which we buy outside this superannuation fund is that we borrow that against some level of equity somewhere, or maybe we use some cash which was sitting in our redraw or offset account. It was already being utilized, right? And we sort of reutilizing it means that we effectively borrowed 105% outside, whereas the self-managed super fund is that you're genuinely borrowing 80%. So let's say if the interest rate is 7 or sort of a mid-7 as such, if I take 80% of 7.5, on my entire 100% of the borrowed money, all of a sudden it's not as bad, right? So while the prices and everything comes in, but super fund definitely has merit.
And I've seen that myself.
Well, we've spoken about it, I think, a couple of podcasts ago on the Pure Property podcast. We spoke about leveraging vehicles like SMSFs to continue your property investment growth phase. And that's what we're speaking about today is this notion of whether or not investing in trust gives you unlimited borrowing power. I know some people who have done this really well on lowish incomes, not right now, but over, like, say, the last 10-year period. If you're going to operate in this space and really try and capitalise on aggressively growing a property portfolio on even a low to a middle income, you got to be all in, right? This is not something you can do part-time, right? Everything is sequence. There's a sequence for everything. You need to be 100% on it. You can't be passenger, right? You got to be super active on this, right? Which means that everything's got to line up all of the time, And I don't know many investors who are that perfect. You might see them, but
I invest for a living, and I know exactly what you're talking about there, Phil, because you kind of, and when you say things that they need to line up, you need to see markets continue to grow, you need to see rents continue to grow, you need to see your expenses be mitigated. You can't have any out of sequence massive renovations that come out of the blue. You can't have any huge vacancies that come out of that time. You also can't see your own income drop away, anything unexpected on that front. Things like starting a family, kids coming along, overseas trips, family members, all those things, they can't happen.
it's got to be perfect.
And there's a lot of luck involved, in my opinion. And I really dislike luck in property, because that's why I like property, is that it's pretty predictable. It's not a blackjack table. It's predictable long-term returns that come relatively slowly.
Yeah, and it can be done. Like if you finely tuned machine, you can do this.
But you do have to be all in, like you said.
Got to be all in.
The plan B really is not a good one.
No, it's not as forgiving. That said, though, like, you know, I've invested in trust for over a decade. It's not that bad. It's pretty good.
But I think you're a bit of a unique circumstance, Phil, where you invested in trust for the right reasons, and you probably had a vehicle. And also, I mean, you're probably a unique personality. I don't give you compliments, and I'm not going to give you one now, so don't expect one.
Makes me nervous.
But when things happen and you know you're a particular individual and you have a runway that gives you time to earn, it gives you time to be patient, and also means that you kind of look at the downside, you're like, I'm happy to mitigate that, and I know internally that I am that person who's able to just work extra if things go bad and find a way to make an extra income. There are ways to do it, and there are certain people who I think make sense, but for not the vast majority, but the majority, it's probably not there, particularly in the first, second, or third. I think you've got to.
So what are the questions to ask yourself, Munzurul? We've got to give people a checklist, and maybe it's a question for both of you. If there was going to be 5 things to know maybe a trust is right for you, what would they be?
A whole lot of things, right?
Well, what are the green flags?
Yeah, so number one is to understand quite clearly what's the setup cost, the running cost. Number 2 is to understand all the sort of the administrative, the tax implication behind it, and be comfortable with that administrative tax implication, right? Number 3 is to have very clearly understanding how am I going to make this trust being positive cash flow? Am I going to get those 8 or 9% return, or am I going to give away some of the deduction and I'm only going to claim 60% of the return? Is that what I'm being comfortable, right? Number 4, I suppose, is to sort of say that, also knowing some of the perceived level of the risk is to know that whether everything is going to align at the right time at a particular point of time, which we're doing, which is what you explained, right? With the rent and the value, the vacancy and sort of the income and all the rest of it, right? And number 5 is to know loud and clear that am I into it for very long period of time?
It's a long-term play.
It's a long-term play. And what is the alternate to it?
Yeah, and as a counter to all this, you may actually want to run your trust at a loss strategically.
And you know what? Very often it does do it this way, right? Because, see, you get a certain amount of rent and you've got a certain amount of expense, right? It's a bit of a newish property, or maybe you've done a bit of renovation. You've got a whole bunch of deduction that you can claim in terms of depreciation. Now, all of a sudden, if I'm sort of going through and assertively saying all of those depreciation as such, it is a negative cash flow.
Yeah.
Yes, very often the bank adds back the depreciation to make it positive cash flow. But again, you're relying on, to a great extent, on the discretion. So while you are trying to really working hard to make it happen, as opposed to naturally let it flow, it just creates sort of
Because it's negative gear in your trust. It's not an individual. So trusts often are negative. You must see a lot of trusts which are negative.
Trust are. I mean, the cost side of it with all the sort of land tax and
they just are.
cost.
Yeah. So this is the cash flow, right? So you need to be able to sustain negative cash flow in your trust. So why would it make sense to retain losses in your trust?
Yeah, the losses gets carried forward forever. So you don't lose the losses, right? So forever it gets carried forward. And what you do is that if there are losses over a period of time, you sort of expect that the property becomes more and more and more positive cash flow, right? The rent increases, whether the interest rate historically sort of more or less stays as average, where we are a bit lower than where we are. So if the interest rate stays as we are a bit lower and the rent sort of increases over a period of time, it becomes positive cash flow. Once it becomes a positive cash flow, I can utilize those losses. Let it be now, let it be 3 years' time. Point 1. Point number 2, if you inject a positive cash flow property in here, a commercial property, then I can use that positive cash flow against the losses. Number 3 is that at some point of time, there is an exit plan. And when we sell that particular property at that point of time, is that we would be utilizing all of those losses at that point of time. So while there are some losses on the trust along the way, the losses almost being seen as an asset, as a bit of a future.
And a lot of people think that's madness. How can losses actually be an asset?
I'll give an example.
It's leveraging the tax consequences of those losses for positive gain on those three examples. I think you explained that really well.
Yeah, and I think that's exactly because when you've got to have that. I think that for me, and I guess my own personal example, and Munzurul being my accountant can probably speak volumes to.
Is he a good client? Do you wish?
He's a very good client.
Do you wish?
Paul is, and I'm not saying it for the sake
Do
of
you wish
saying
he
it,
wasn't your client?
Oh no, he's a perfect client, right? He's a perfect client. And what is a perfect client?
Lots of fees.
Every time Paul and I will speak, is that we bounce off so many ideas, and there's so much that one learns, right? So, I love it.
No, and I think that's a challenge every time we make a phone call together. It ends up going on a different tangent. We talk about something else, and then but I love it because those catch-ups are what enlightens me and gives me information, and vice versa, no doubt. But I think I've given a recent example. We're just talking about it off airfield. Is that I do active developments aside from passive investments in my own separate company that I've set up. That's just private. There's a property that we bought probably the best part of 2.5 years ago for a bit over $3 million. Built a duplex on that property only recently, completed it, sold one, about to sell the other. Total sale costs are going to be circa probably $8.5 million gross revenue. Purchase was about 3.5 after stamp duty, etc. To build it was about another $3 million all in after all said and done. So call it 6.5 in. That's taken 2.5 years to get to that point in time.
$2
Well, potentially gross, but then you say, okay, well, in the last 2.5, 3 years, there's been a lot of expenses. Now, I'm paying interest. I'm paying an awful lot of interest. I've also paying construction costs, construction interest. I've got land tax that is every year paid. Now, cash flow has been highly negative, highly negative, hundreds of thousands of dollars a year negative. So we needed a war chest of cash to even just cash flow the project, cover the spread, and those losses. So the last 2.5, 3 years, there is a big loss that comes with this. Now, technically on paper, I'm making a profit. Now that profit isn't all mine. Clearly, there's going to be a whole bunch of capital gains tax. I also have to pay GST, and then there's a range of other things.
Completely different.
There's a whole different war chest of other things which you throw away. So again, it's not all profit, far from it. But I guess going back to the reason why this property's in a trust is that we can be quite creative in the sense that legally, now I've got all these losses which I can apply to these gains. I minimise the tax on the actual CGT that I would otherwise be paying once his profits are rising. And that's an example which it's a clear cut. If I did that on my personal aim, that's how
you'd be stuffed. And you raise a really good point, Paul, because I know that the tax office tune into podcasts like this.
Absolutely.
And I think it's good because I'm a proud Australian. I pay my taxes. I pay a lot of taxes, as you guys do, and I'm happy to pay my taxes, right? However, what you're talking about there implies that you're trying to potentially get around tax.
No, far from it.
And you're not, right? And this is why you need a really good accountant, because there are certain rules that govern the tax regime in Australia, and a really good accountant knows how to apply them effectively within the rules. And that is the key thing. You know, if you have an accountant and you're operating in property, make sure they play by the rules, because everything they do needs to stand up on the basis of an audit, and it's absolutely critical. So, yes, you're looking to get the most effective tax outcome you want, but that's all within the regimes as dictated by the tax office. And
correct.
A really good accountant knows how to apply those things effectively.
Yeah.
And that's the key. It's not trying to get around tax. It's just how tax works.
No, it's 100%. Absolutely, generally. Everything what we do as an accountant and everything all accountants should do is should do a return with an assumption that everything gets audited by ATO. Anything which doesn't sort of fulfill that sort of the ATO requirement, it must not be doing it. So to give you just one example, that on sort of Paul's case, right, when you make that bit of the profit within that trust, is that you can distribute that within the law on the basis of the trust deed of the beneficiaries. And if we look through into the definition of the beneficiaries, that includes kids, grandkids, parents, grandparents, brother, sister, nephew, niece, uncle, aunt, as well as any other entity that you've got some level of ownership or some level of control. So the point is that trust has got a lot of flexibility in terms of the distribution.
Yeah.
That's all within the law, right? And those are the two benefits that
So you can't distribute. You can't you can leverage losses, but you can't. You can only distribute gains. Correct?
That's right.
Yeah.
That's
okay.
right. That's right.
So on that basis, then, if you have losses, and we're getting a bit technical now, but a sense for the sophistication of this, if you think that it's a panacea for all your problems as a property investor, you can leverage those losses in the trust through other entities. Should there be commonality within the rules of ownership?
The losses you carry forward.
You carry forward the
You
losses,
carry forward the
but you can
losses
distribute.
the
So if
profit.
you've got losses somewhere else, you can distribute that over into it, and therefore that's the flexibility around the tax
That's
structure.
right. I mean, there's a couple of things that one need to go through within the law, right? You may potentially need to do a family trust distribution election. You have to do minutes. You have to do trust distribution notes. So there's a whole bunch of things that one needs to do. Physically, the cash needs to go from entity to another entity. But within all of those rules and more, the answer is yes, one can.
Okay, this way you need a good accountant. Do you know any, Munzurul? do you know what I actually want to dispel this, because you're quite well known in property circles, and I think it's time for you to come out of the shadows, by the way, Munzurul. But what I would say is that I know KHI Partners, and I'm sure you're happy me giving Munzurul a bit of a plug here. KHI Partners is more than just Munzurul Khan, isn't it? There's you have a suite of partners who are hugely capable, and just by working in your firm, no doubt they're property centric as well, right? So there's more to KHI Partners than Munzurul Khan, yes?
Definitely. No, absolutely. We've got 23 partners and
Okay.
5 different services that we do. So, yeah.
Yeah. Okay. All right. So there's more than just Munzurul, but
Definitely.
I'm sure, Paul, you want to keep it
That's
to yourself.
exactly like KHO Partners, more than Munzurul.
More than just Munzurul.
Absolutely.
But you have a wealth of knowledge, and you're are you an accountant first or a property investor first and accountant second?
Yeah, good question. I want to stay as an accountant first. And the reason I want to say I want to stay as an accountant first, because this almost gives that accountability, that righteousness, and doing the right thing as such, right? It's sort of always sort of that ticking that box. Yes, property investment at a point of time many years ago, it was a hobby, and it sort of grew quite a bit more. But I still want to stay as an accountant in terms of ticking those boxes.
So how do you know if your accountant is a good accountant when it comes to trust-based property investing? What would be the one or two questions, probably a question for you also, Paul. What would you ask them to see whether or not they see the world the right way?
Look, anything which is too good to be true, very often they probably are.
Yeah.
And anything which sounds that, wow, this is something brilliant that I came up with, and no one sort of came up with this brilliant idea for last about 50-odd years or 70-odd years of investment. One just need to be a little bit careful and look through that. Am I missing something, right? There's so many things that have happened in that trust in the back. All the way back many years ago, there was this book I remember called Trust Magic. And
Trust magic.
Oh, this was like 25, 30 years ago.
Like Pavlova magic. That's still going.
That was the book, right?
Yeah.
And I remember for the first time I read that book, I was like, oh, I love this book, right? Now I sort of look back and I say, all right, there may be a couple of things one does a little bit different way, right? So one got to be careful that if it sounds to be too good to be true, number one. Number two, one also got to be careful that whether there is a self-interest for any profession, right, from an accountant side of it and say, right, very often when I sit down with an investor buying their second property and try to talk them out, I say, guys, if I were to do this trust, it's a good thing from my point of view, right? We're charging you the setup cost and charging you the running cost. So why am I talking you out? Because that is the right thing to do in the longer period of time.
Yeah. Hence the reason why accountants are the trusted advisors.
Yeah.
Yeah.
Yeah, and I think the last one I'd add to that, and those two are pretty much for me the first and second, is that the third is really understanding their interest and their own personal investment in the property space. And more
So if
often
your
than not-
accountant doesn't invest in property, probably not the right accountant for you.
I mean, I don't want to. I mean, if
I don't want to generalise
if
here.
they're a 25-year-old graduate who's just getting started, there may be a reason behind it. But under to Munzurul's point, with 23 partners under tutelage, I mean, I would probably go out on a limb and say that a lot of Munzurul's partners within his accountancy firm are also property investors. And it's not just him. And I'd also say for myself as an investment property buyer's agent, every single one of my team members, whether they're buyer's agents or support staff, they're property investors, and that's what they need to know, and they also need to understand the whys and why nots. And I think to your point, Munzurul, there is the big one is for me is how are they incentivised, and I think that drew such an interesting parallel for me is that the fact that you would do your best to talk someone out of making fees off them because you know full well that you want, I mean, selfishly, you also want that person as a client for 10, 20, 30 years. but you want to be a client. You want them to be a client who also recommends because you've got their best interests at heart and you want them to get the best outcome. Same thing when we're talking about a client who comes on and we essentially might have capacity to buy 2 properties at $900,000 or $800,000, but does that make sense to split it across 2, or do we consider is it one asset at $600,000 to $800,000? I mean, fees are one thing, but we want first and foremost to get that outcome. And I think to your point, those 3 things you raised, I think grill your accountant on those components, because without those, I'd be questioning, are they really going to be that effective long term? And probably the other one too, when you're picking a GP, this is one thing that I always remembered back in the day. You kind of want to pick someone who's going to go through the journey with you, or at least a firm that's going to go through the journey with you. And a lot of the times I find that property investors who are clients of ours might have an accountant who's potentially retiring soon, and all of a sudden they're like, well, what do I do with this? You kind of want to not necessarily marry up age for age, but if they're there and they're mid-30s, mid-40s, even in their early 50s, and you've got 10, 15, 20 years and their firm's got a track record and they've got other partners that can also work with you who might be slightly younger, you want someone who's going to be there with that journey for you, because advice is great, but if you're only getting it for 5 years and all of a sudden they disappear,
it's continuity.
Continuity's key.
So are you going to get annoyed when everyone calls you up going, Paul, yeah, you sound really good on the podcast, but how do I find Munzurul? Are you going to protect him? And
it happens a fair bit. I'll give Munzurul maybe a little bit of pre-warning. But and full disclosure, look, I refer a lot of clients to Munzurul. I don't get paid. And Munzurul doesn't get paid by referring any clients to me either, by the way. And we try to make sure that's been something that we've had for 10 years. And for the reason that we want people to get good advice and make decisions based on that advice. And if someone's going to go to Munzurul or vice versa, or somewhere else for that matter, we want to make sure that where they're going to go for that advice first and foremost is going to be unbiased and essentially looking at what do they get.
So on that basis then, is Paul a good buyer's agent, Munzurul?
Oh, there's a reason why he's so successful.
He's the top 50 in Australia.
There's a reason why
One of the top 50.
I was, until there's now 10,000, or probably at least top 5,000 now.
Yeah. He's a top 1,000 buyer's agent. You must see a lot of buyer's agents though.
There's a lot of new buyer's agents coming through, right? And you're right. I mean, there's a lot of new buyer's agents coming through, and many of those buyer's agents, and I'll say that with a lot of respect, right? You speak to them, and I was like, it's sort of just the practical experience isn't there. Right, like you can read and you can do all those different things, right? And you can make lots of noises, but is the real practical experience count through, right? I mean, Paul, you and I, we know each other 10 years, 12 years, and probably even longer, right? Yep. And your investment journey is that much longer, same as from my point of view, same as from your point of view. Yeah. So it's the experience, right?
Yeah, okay. Well, there we go. No, well, thanks, Ajay. Thanks, Munzurul. No. You're a fountain. Are you a wealth or a fountain of knowledge?
I think he's a fountain of youth. Munzurul looks the same age as he does today. I still don't actually know how old Munzurul is, and I don't want to ask because it'll give it away.
No, Munzurul will still be there at 100, so 100%. If you use him, he's certainly on your wealth journey.
Absolutely.
All right, so what we tried to do there was dispel this myth of investing in trust gives you unlimited borrowing power. I think we've gone, no.
Yeah, probably not.
However, speak to your accountant.
Time and a place.
Time and a place for it. All right, Paul, that's good.
Yeah, mate. I think it's an important one as a stake in the ground for anyone who's thinking about this, because
it's a bit counter-cyclical, because a lot of people might be going, don't talk about that, Paul, because people should be investing in trusts.
Yeah, absolutely.
Where do people send their hate mail if they want to question you?
Hate mail at purepropertyinvestment.com. Inquiry at purepropertyinvestment.com will do the job, and we can filter that hate mail. Probably
send it my way. I'll get lots of it.
Absolutely, no doubt. Yeah, just fill up your war chest, the Grinch mailbag.
Yeah. Don't worry, mate. Yeah, get it. All right, no, good. No, well, thanks for your time. Thanks for your time, Munzurul. Great to see you. Look forward to seeing more of you around. I'm going to tap into your mindset. I get asked a lot around sort of accounting-based stuff, and I'm not an accountant. Even though I sort of nerd out on accounting stuff every now and then.
You do.
Yeah, you are. Phil does.
He does. Tell you what, you can go down rabbit holes with you about structures and far too clever for your britches.
I'm not. There's one thing I am not, and that is clever, but I'm smart enough to surround myself with people that are. There you go. That's a compliment to Munzurul.
Thank you.
Not you. Not me.
Not you.
No, thank you. Appreciate it.
Well, there is no conflict here. I've never used Pure Property for for buying? I probably should at some point.
You have asked me a number of questions.
I get free advice.
Yeah, exactly. You do seem to get a lot of free advice.
Yeah,
It's,
I get a lot of
it's
free
very
advice.
interesting.
No,
how
I'm
that
going to
works,
I'm
isn't
going
it?
to start buying again.
Right.
I'm going to start buying again.
Yeah. I did put you onto a few markets about 2 years ago.
When
and you said
interest rates start coming down.
Yeah, right. That old chestnut. When it gets cheaper.
Mate, I'm
to borrow.
skint. I
Yeah.
can't. I'm tapped out. I need more trust.
So you can empty the sleeves of that puffer vest. I'm sure it's full of cash.
Full of hundreds.
Macarinas over there.
Well, I'm going to conclude with this. You said there is some markets which are beyond their peak and on the way down from a buying thing, and there's some markets emerging. Give me one that's past where it was and one that's emerging. Quick.
Okay, past where it was, Hobart.
Oh,
certainly.
Tell us somewhere in Australia.
Tell us something I don't know. Adelaide.
Adelaide. It's done.
I mean,
Still good,
again, the
but-
data won't
yeah.
say it's done,
Yeah.
and it won't say it's done for probably 6 months. But I think for me personally, we haven't bought there for some time because we see that the value's probably been fully extracted.
Okay. And the other on the up and up and
See, I don't say on the up and up, but I'd say
Melbourne.
cheap is parts of Melbourne, parts of broader
I
metro.
actually did a thing the other day, and I'll conclude with this, where I went through the smart property portfolio, and I was really surprised at some of the values in Brisbane.
Yes.
I was like, God,
high.
Like we got there's
Really
an apartment block in there with like two better things. They're like $430,000 an apartment.
Yep.
I was like, no. The last time I went through this process, I was like, even bank values. I was like,
70%
that's
less
mad.
than that. Yeah.
It's absolutely mad.
and
Then I looked up one of the Melbourne places and I went, oh, that's come off.
Yeah, and then you're like, well, hang on. And then you sort of...
And I was like, yeah, Melbourne's the place to be.
And dial back, well, even if you're thinking affordability, but dial back 30 years worth of data, I tell you what, you look at it and you're like, man, Melbourne's performed really well in 30 years. And then you say, what's happened in 5 years? Well, if anything, it's been flat.
Maybe we can talk about that next time we get here.
We will. There'll be some more talk about this. I can tell you firsthand that
do I got to call up my friends over at Virgin and say, where are all the buyers agents flying to?
This is the problem.
You know I can do this.
And this is the problem. You need to be patient because you buy. I can almost unequivocally say you buy Melbourne today and look at the numbers this time next year. You won't be amazed.
Yes.
That's the part which property needs to be thinking 10 years, and that's the mindset that has to be.
Are you buying in Melbourne yet, Munzurul?
Mate, I actually bought 3 properties in Melbourne last
you
year
did.
in Melbourne and in my self-managed super fund exactly with that view. The rents were low. I didn't expect a lot of growth in short to medium period of time, but it's just that the numbers make sense. You know, when you spoke about the Brisbane property and saying those apartments are 400,000 or so, I remember, say, 4 or 5 years ago, is that everyone's sort of saying Brisbane market will never do anything. It never does anything. It hasn't had any growth. It hasn't do. So sometimes the memories are so short, and we just look into that at that point of time. I'm a big fan of Melbourne at the moment.
Yeah, okay. There you have it. Lots of things to talk about. Thanks for tuning in. Remember to go and check out Pure Property Investment, purepropertyinvestment.com.
Just .com.
.com.
1300 985 428.
Do you want me to test the number again?
Try it again. No, don't do it. Don't do it twice.
I don't have my phone of me. It's getting
Lightning
fixed at
doesn't
the
strike
moment.
twice. That was a good test, that one.
Yeah, it's good. I reckon a lot more people called it up to see what it's working anyway. Thanks.
That's where we'll get the hate mail.
Yeah, probably. Thanks for tuning in, everyone. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.